Right, so our first question that came in via email was from Sal. And Sal, I didn't have a chance to put in the proper prices that you had put in the beginning. So Sal has been rolling a short put position on stock MRIN. He sold an October put in September and bought to cover it as the stock started to decline, rolled it out to a November 10 strike put with the stock, got another $295 premium, but had to buy it back for $460 as the stock continued to fall. Effectively, he rolled the next one. He's rolled it a couple times, and the stock has been declining on him. He's now holding the March 10 put at MRN, trading at $453. And he collected $540 for it, and the buyback price is $590. Again, it's still falling, excuse me. It went up $1.08 today, so that's a pretty good jump for you there in that case, Sal. But he's got 70 days to expiration, small time value on the position remaining, and what he was considering is getting another $2 in premium or so, or another, I'm sorry, it's 20 contracts, so getting another dollar gain in premium by rolling all the way out to January 2023. And he wanted to know if this is a good idea. Now, right now, because I haven't put in, let's just take a quick look at the profit and loss chart for this position. Because I didn't have a chance to record the other premiums that were sold against this, the break even, since he had to buy back some of the puts, so originally he sold the October 15th put at 141, had to buy it back at 230, and rolled out to the November at 295. So he rolled for a credit, buyback of 230, and an increase by 60 cents to 295 new premium. Then he had to buy that back at 460, but rolled it out to the March at 540. And this is the continuing trend that he's looking at. What about just taking this March 10 put and going all the way out to January 2023? By Sal's admission, by the numbers that he has, I didn't get a chance to verify this. The break even is not at 460 because of those extra premiums to buy back. He notes that the break even is currently at 717 on this position for the buyback cost on MRIN. For the stock to, goes to zero there, his break evens actually appear at about 717 or so. Okay, so what are we talking about? Well, we know if we went to buy back the March 10 put right now, we saw that price at about 590, midpoint of about 590. Just on this transaction alone, what does that leave us with? That's going to leave us with a 50-cent increase in the cost basis. So the break even would technically, straight line profit and loss chart is how it's reading it in this case. We kind of have a low gain there. So we're essentially buying it back at 590 for the 50-cent loss. Now let's just clear that out. I want to look at this potential trade first before analyzing others. The midpoint on this position was about 685. Okay, but just taking the standard position we initially had, keeping the 20 contracts, let's see, is it 685 or 680? Yeah, 685. Let's take that 50 cents we just lost to buy back this put at 590 right now. And we're going to take the new premium we take in, we're going to reflect that with 635, 50 cents off of the premium we're going to get, factoring in the 50-cent loss in that case. Now, it shows a break even of 365, but remember, we have those other premiums that added into the position. So the break even's actually a little bit higher in that case. We're up probably still near the about $6 range in that case with the others factored in. But again, the stock's at 453. We're 2 points away from break even. That's about the 1.5 or so he collected against it. But now where are we? We're sitting on this 10 strike put that's out 378 days. Is that important? Well, let's take a look back at the position right here. Again, we know we have a little bit of time value remaining, as the option is about 547 in the money. So that sort of, 43, 44 cents of time premium still exists on the 590 cost. I'd like to see some more decay, but I know I'm not going to see that anytime soon. Unless the stock starts to move up, that remaining 40 cents is going to decay slowly over the next 70 days. Might not want to wait that long. But what I wanted to take a look at here is I'm tracking any position in the portfolio, whether it's a covered call, naked put, credit spread, debit spread, and so forth. We can go to the position actions menu, and I can go to position analysis. This gives us a current breakdown of our position. Again, I could mimic just saying that the option premium was at a different price, so it could reflect the true break even of 717. We're going to keep the 540 here for the math. I'm sorry, there we go. We see the delta, 9.5% time value remaining. That's the 43 cents, close to 10% of the stock price at 450. And, we're at a loss of only 5% right now if we liquidated this position at expiration, even if the stock's at 453. Well, this isn't accurate again because the break even, as Sal mentioned, is 717. Now, why I wanted to show this is you're not necessarily rolling for a credit, but rolling to a debit at a lower strike. The portfolio gives me opportunities, of course, to roll down here to the June 750 put. Now, I'm going to have to pay 590 to buy this back, but I can go down in price to the 750 and collect another 395. The total adjusted net credit from this transaction would be 345. That's just looking at the 540 initial price, Sal, minus your 590 buyback and the new 345. But why don't you take a look at this here? The average naked yield annualized returns at 104. It'd be a 46% return if it expired worthless at 750. Again, your break even's a little bit different, I know, but I just wanted to look at these numbers real quick to show that keeping the same price, even though you're getting that extra dollar premium, might not be the best idea. That you might get a better break even in this case, lowering it down to 405, potentially lowering your break even from the 717 down by another 40 or 50 cents, even rolling for a debit, because you have the 750 strike. You might be down at the $6 range. And this is only out to June. This is not out to January. You're not rolling for a credit, I understand that. You're rolling for a debit in this case. But what is the goal here? Is the goal here to extend the trade, just keep collecting premium to eventually hope that you can buy it back in profit, knowing full well that you're not going to start to see this decay that you roll to with the 635 until you get closer to the last 3 months. In other words, if Marin stays right around 453 and you're holding this January 2023 10 strike put, I wouldn't expect to see a lot of extra time decay on this position if the stock just keeps hovering around this price or even drops back down back to where it was earlier yesterday at 350, 375, 380, pulls back to that 4 strike. The time decay curve, as you know, we really only start to see that good decay in the last sort of 90 days, 60 days, 30 days in that case. We're out here at 378. And right about here is probably 120, is 4 months in. So you're talking 258 days of time before you start to see any good time decay on that position to buy it back, roll it again, or maybe improve your status. That's a long time. Rolling out to that June potential series and rolling down the strike, I'm only increasing it by an additional 90 days or so, going from our current expiration of 70 days to 161, so pretty much exactly 90 days, and you have the potential to lower your break even in that case from where it was because you're lowering the strike and that as well. So I want to go back to that screen here. Okay, so I can't answer your question directly, Sal, in the sense of I can't give you direct advice on what you should do. What I'd like to see you do is put in the historical positions that you had with the premiums that you had. I can help you with that later this weekend. Perhaps I can go into your portfolio, Sal, and I can put those positions in based on your cost basis of what you did and what you rolled. So we'd see that true reflection of the break even right now at 717 that you mentioned. That will help with the analysis. Then what you want to decide is, what is your outlook for this stock? Do you think that this $8 increase today. Let's just go to big charts real quick. Going down, going down. What was this jump caused by? Was it positive news? I could check easily and see if it was the earnings, but was it some other news or something that came out that might lead you to believe that a trend like this on this volatile stock could continue, and you might see it in the next 40 or 50 days up another point or two because of the growth in the position? Whatever caused this new spike to happen, does that change your sentiment to where it's going to move up? If so, this might be a good target for that June play. Again, depending on if it helps the break even enough by lowering the strike price down to 750, even though we're rolling for a debit at this time and not a credit. Or do you think this is just an aberration and the stock might go up to about 550 or 6 and stay there? And what you're looking to do is just hedge what looks like losses right now on this position by continuing to generate income, and you don't mind staying in the position for likely another 250, 260, maybe even 300 days before you start seeing more of that time decay in the position. There's a chance that this amount of capital you have tied up in these 20 contracts, this $20,000, you won't be able to do a reasonable or effective management with this position in the next 90 days unless the stock sees a significant movement upwards, simply because you're not going to see the time decay on this position in your favor unless the stock starts to move up and you're losing that extrinsic value and the option itself is coming cheaper to buy back and you're getting closer to the break even. But again, if you think that might happen, even in the next 50 days or beyond that, maybe the next 100 days, depending on your outlook, Sal, then I might consider using a shorter term roll, even lowering the strike, even though I'm lowering for a debit. If you're concerned about the stock reversing back, going back down to $3, back down to $3.50, continuing that downward trend, just rolling for the sake of rolling and get an extra $2,000 might help. But again, even if the stock's declining, you're not going to see a lot of the extrinsic value on this 378 decay in your favor just based on the time value curve. A lot of it's going to start going up to intrinsic there, Sal. But again, the benefit that you get from this is buying it back. Yes, you collected the premium in, but buying it back at a cheaper time value to get a higher advantage of that time decay that you want to help the position. This might be putting you in a situation where you're seeing little to no time decay potentially for the next 200 or 250 days or so before it makes sense to buy it back or try to readjust the position. You want this time value to start working in your favor. But if it does look like your concern is the stock's going to continue down, then you might want to consider a whole nother game plan altogether. So Sal, I'll try to look at that sometime later this weekend and get that, into the portfolio for you with the rest of the historical prices. I did not have time to get in today, so we can evaluate the proper break even in that case and see the rollouts and how they would affect it and evaluate that against the rollout to further out in time as well. So I'll put this at the end of your, Sal. You said you updated the portfolio. You're trying to avoid being assigned by going further out in time, with although you're even in the money further out in time. You have less of a likelihood until you get closer to expiration. I understand that. But eventually, if the stock keeps going down, we have to decide what's best in that scenario.